Hey everybody, welcome to the Investing Education channel. So it's the end of January and the start of Feb, and so I'm here to report how the account has been doing. The account has not been doing too badly. It's been doing quite well actually. I think for January, it's up year to date about 12%, and I think that's pretty good. I mean, let's see. Of course, this is not a short-term thing. This is a long-term game. So, eventually we want the account to reach, a much higher value. But I think it's a good start to 2019. January has had many earnings, so that has made the account a little volatile. But so far, it's been volatile on the good side, on the upside actually. Some of the big names that made some of their earnings known to the public this month were Facebook, Intuitive Surgical, Visa, MasterCard, Amazon. I think Google will also be reporting soon. Facebook in particular had a good result. The stock really shot up after its earnings. Intuitive as well. Visa a bit slow. Master did well. Amazon, I think the results were actually quite good, but the stock didn't quite react the way I expected it to. But of course, I think these are very short-term blips. I think in the long term, I can expect Amazon to go much higher as well. So, I mean, as I mentioned in my previous videos, the strategy is really simple. I mean, the essence of it is to look for very high quality companies, which have very strong and durable moats, and you don't want, of course, to overpay or pay exorbitant price for them. You want to have some margin of safety, and when I say margin of safety, that's not just in terms of the price. That's in terms of the quality of the company, whether it's any tailwinds going for it, whether it's monopolistic, how aggressive the competitors are, what is the situation around that company. So I think all these factors add up to my concept of margin of safety, and give a company a very strong moat as well. So a lot of these companies have very strong positions, and I expect them to get much stronger as well in the long term. So the good thing is, it's a simple strategy. You do nothing basically. You just invest in these companies for the long term, and then you let compounding take its effect. I expect the account to do about 15 to 20% for 2019, barring any unforeseen circumstances. Of course, along the way, if there are good opportunities to buy more, I will definitely be buying more. I'll be adding in more money as well. And as the stocks rise, basically, the account value should rise as well. Like I mentioned before, I mean, this account is really, set up for a very large value. So if the amount that I was investing in was 130 million, I would probably have the same kind of distribution among the stocks I have right now. Like I mentioned, I also want to have more exposure to some other stocks like Boeing. Unfortunately, Boeing has shot up again, so I'm not sure if I'll be buying into Boeing at the moment. But I mean, again, over the long term, sometimes it doesn't really matter. Even if you buy at a slightly higher price, if the company has a durable moat, that company is going to go up in price over the long term. So these are certain psychological biases that even I have to sometimes overcome, and it can be a bit tricky. So I mean, let's see. I mean, I might buy a bit more of Boeing and some of these other companies if I feel that there's a good entry point for them. I think the other thing I want to do for this account is I want to compare it against some of these other top fund managers. So I mentioned Fundsmith, for example. Let's go over to the website. So as you can see, Fundsmith has also, I think, put out a positive month. If you go down to, this is the chart, if you go down to the year-to-date results, it seems like it's about 4.26% for year-to-date, which is pretty decent. I mean, of course, over time, I expect fundsmith to do much better. But let's compare it to some of the other investing grids out there as well. So, I mean, of course, we have Berkshire Hathaway. Berkshire Hathaway is taking a bit of flack right now because, of course, Apple, one of his biggest stock positions, didn't do too well. But I expect it to go up, of course. So it's about 1.4%, I think, for the year. Uh, Another company I follow, Markel, because I think Markel is like a mini Berkshire Hathaway and might have a longer runway as well because the person in charge there is much younger. But they follow the same strategy and they have the same setup. They have insurance and business, and they also invest in very high quality companies. So I think over a long term, Markel might do a little better than Berkshire. So which is why I compare it, with my performance as well. So and true enough, Markel has done a little better than Berkshire for the year so far. It's done 3.1, and then of course we have the S&P 500, which has done about 7.7%. So the market has been bouncing back in general. So that's it, guys. I hope you enjoy this update. Let me know what else you would like to learn from this channel, and I hope you all do well in your investing journeys as well. Thank you and have a good day.